You can't buy property without any money.
What do you mean? What do you mean? What do you mean?
And in today's video, I'm going to be sharing some tips about buying and building a multi-million dollar property portfolio and how you can exactly go about funding that. Because it's all well and good to save your hard-earned money, create disparity between your income and expenses, but you're not going to be able to save your way to wealth. So let's dive into some of these tips about how you can build and finance a multi-million dollar property portfolio. Step number one is to get pre-approved for your very first purchase. You need to start somewhere. And what that means is saving some money. So like I said at the start, you've got income, you've got expenses. You need to make sure your income is higher than your expenses. That disparity will be your savings. You can take those savings plus your day job income and use that to get serviceability with a bank. Whether it's Baxter Hill from Woodrow Finance or any broker or any bank, Emily and I actually dealt largely with CBA when we were building our property portfolio. Find who works for you, whether it's a broker or a bank. Find the person that's going to listen to your situation, look at your income, look at your expenses, look at your balance sheet or the cash that you saved, and give you a pre-approval based on that. That number is then going to enable you to look at your very first property purchase. Because we all have a limited borrowing capacity. I don't have a money printer. You probably don't have one either. And so you need to look at your personal situation and work out what funding you can get or what debt you can actually get secured against a property purchase. So for Emily and I, we'd saved about $66,000 for our very first home, and we went out to CBA and asked for our maximum borrowing capacity. That's the next tip. Make sure you get the maximum. Don't just ask for a $600,000 borrowing capacity because that's all you think you want to buy. Get the maximum borrowing capacity number from your broker or your bank. This will let you look at whether you can buy 2 properties in one go, or whether you need to create more equity in the property purchase you're looking at to go out and refinance and buy again. Another huge tip is obviously to try and increase your day job income. The higher income you can have, the better your serviceability is going to be. A lot of the banks have a 6 debt to income ratio or a DTI. And all that means is most of the banks or most of the big tier banks won't lend you more money than your 6 times debt to income. So if you earn $100,000, most banks as a general rule of thumb wouldn't lend you more than $600,000 because that's $600,000 against $100,000 of income. So a 6-to-1 ratio. So if you can increase your income by $50,000 or another $100,000, you could potentially double your access to debt if you have the serviceability. So boost your income for that short period of time while you're acquiring your assets. Now you've gone out and you've had a chat with the bank and you've gotten those documents in place. The next tip on my list is using the power of leverage to your advantage. If you're able to get access to the first home buyer scheme and you only need to put 5% down for your very first property purchase, then go ahead and do that. You don't have to pay LMI in that situation. So why not take the government's guarantee, go and buy your first home for $500,000 here in Queensland, put down 5%, which is 25 grand. Even if you have $80,000 or $100,000 saved, put down just the minimum for that first purchase and then go and look and acquire the next asset with a 20% deposit. So be smart when it comes to leverage. Look at your own situation. Generally, Emily and I tried to put 20% down because we wanted to avoid paying lenders' mortgage insurance. But in some cases, you may need to pay it. You need to look at your own situation. If you think you're better off getting into the property market sooner, then paying for that lender's mortgage insurance may absolutely be worth it. The other situation where LMI might be really worth it is if you want to boost your borrowing capacity. So if you want to potentially buy a higher priced property and get in with less of a deposit, that's where using LMI might suit you. The next tip on my list when it comes to financing and funding a multi-million dollar property portfolio is finding the balance between capital growth and cash flow. You're going to need capital growth to continue to acquire assets, but you're going to need cash flow to continue to service a property portfolio. So generally in my business at Purpose Property, where we help people buy here in Southeast Queensland, that's our high level strategy. We like to grow for growth first and then transition to cash flow assets to balance out the portfolio. The reason is you can use those growth properties to acquire more assets. And then you can buy cash flow assets to balance out the portfolio and transition your portfolio to a more cash flow play where you're looking to draw dividends from your asset base. Now, gone are the days of buying 0 to 130 properties in 3 years. which is Steve McKnight's story. You can't do that anymore. You can't go out there and buy an endless positive property portfolio. You are still going to hit a cap at some point in terms of the debt the bank is willing to lend you, even if you have a 6, 7, 8, 9, 10% yield on those properties. A lot of the banks are going to have yield caps or location caps. I know, for example, our property in Coffs Harbour, a lot of banks won't look at that because it's a regional location. Even though there's over 100,000 people in that area and it's a diversified economy, some areas that are higher cash flow, banks will have restrictions on. So look to balance the capital growth and the cash flow throughout your journey. Now, one of the ways to fast track your property portfolio is to add value in the short term. Don't just wait on the market to increase the value of the property, but manufacture value to force your way forward faster. That was a bit of a tongue twister. Force your way forward faster. And isn't that the truth? That's exactly what Emily and I did in our property portfolio. So as we were looking to build our multi-million-dollar asset base, we were able to take our first asset, renovate, spend $30,000, $50,000, $80,000, double our money, and then go out back to the bank, get a valuation, refinance the property, and buy our next property with the increased debt we'd taken on. So this is a way you can fast track your own journey. If you've got the team or you've got the skills, you can go out there and renovate properties to boost the value. I'd highly recommend doing this on cosmetic renovations and trying to avoid structural projects. You can potentially make more equity and more capital gains in the structural project, but you also have the higher risk with those higher potential gains. For most investors here in Australia, you're going to find it easy to do a basic cosmetic renovation, spend less than about 10% of the property's value in those renovations, and try and look to create $2 for every dollar that you spend. So every property that Emily and I have bought in our property portfolio, we've done this renovation strategy. And I like to call it pulling the lever. Pull the lever on the renovation to boost that value quickly. So our first property, we spent about $75,000 and we're able to pull out about $130,000 after that renovation. Our second property, we were better at the actual renovations, which was the Baby Queenslander. You can go and see the renovation series here on YouTube. We spent about $35,000 and doubled our money. So we're able to get access to $70,000 worth of equity, and so on and so forth. So we've done this for every property that we've bought. Now, part of building this asset base means you might want to diversify. You don't want to end up with all your eggs in one basket. Now, Emily and I have roughly around $3.5 million worth of assets in Southeast Queensland. And I'm personally very bullish on the Southeast Queensland market, both on a macro level and on a micro level in the suburbs that we're picking in a buyer's agency and the suburbs that Emily and I have invested in personally. So based on the macro and the micro, why not put all your assets in Southeast Queensland? The reason is diversification reduces your risk in some of these areas. So that's why Emily and I bought in New South Wales. It was for diversification to reduce our risk, and it was because of tax planning. Now, when it comes to funding and financing the portfolio, building this asset base, renovating the assets, and seeing capital growth is great, but you need to also look at the long-term holding costs. You'll need to look at the management and the land tax and how these assets can affect your future borrowing capacity. One of the reasons we bought the unit block in Coffs Harbour was to boost the cash flow in our property portfolio, but it was also to spread our land tax. If we'd had $5.5 million worth of assets in Southeast Queensland, our land tax bill would have shot up significantly. But spreading our assets through diversification and buying in New South Wales meant that we would pay a lot less land tax, if not no land tax across our property portfolio. So it's really important to take all of these things in consideration as you build out your multi-million-dollar property portfolio. Really, it comes down to your ability to work with the brokers and the banks to get access to the money, making sure you're acquiring the right assets at the right time in your investing journey, and looking to diversify and manage the asset base going forward. So the last point on the list is to be patient. Yes, we do want to reach the end goal of financial freedom and we want to build that asset base, but make sure you're strategic and patient in making those decisions. Probably the worst decisions in my portfolio were made when they were rushed, or I was trying to make money at a faster pace. So it's important to be patient and recognize that property is a long-term game. Let the assets do a lot of the heavy lifting for you. Yes, you can push and manufacture value and you can create businesses and boost your day job income, but at the end of the day, you need the assets to grow over time to create disparity between the debt and the value of the property. and give you that passive cash flow on the side. So do your research, build your team, and be aware of the risks. So if you're interested in taking your investing knowledge to the next level and you want to understand detailed examples around trust structures, around financing, and building this multi-million dollar property portfolio for yourself, then head over to purposeproperty.com.au and click on course. For under $500, you can get an end-to-end guide on building a multi-million dollar property portfolio. You can actually see all of the modules in the course. So if you go over to purposeproperty.com.au, click on course and scroll down, you can see every single module in the course and exactly what's broken down. It's over 3 hours of content, and it's like sitting down with myself and seeing how Emily and I built our multi-million dollar property portfolio. So if you're interested in that, head over to the website and pick up the course. Otherwise, thanks for sticking around, and I'll see you in the next one. Peace.